Most traders lose because they enter the market exactly where the institutions want them to, at the worst possible place, right before a reversal. And the reason is simple: liquidity. Liquidity is the fuel smart money hunts before making any real move. And until you understand how it works, the market will repeatedly take your stop loss, sweep your levels, and reverse without you. In this video, you'll learn what liquidity truly means, why the market intentionally hunts your stops, the different types of liquidity zones you must master, and how to use liquidity to take sniper-level entries instead of becoming liquidity yourself. You'll also discover how institutions engineer liquidity, creating fake highs, fake lows, and too perfect zones just to trap retail traders and load their orders. By the end of this video, you won't just avoid becoming liquidity. You'll start trading using liquidity the same way institutions do. What is liquidity? Liquidity in trading is the fuel that moves the market, the pool of available buy and sell orders that institutions use to fill their massive positions. In simple terms, liquidity represents the money sitting above highs and below lows, stop-loss orders, pending orders, breakout traders, and trapped traders waiting to be taken out. The market is not moved by randomness. It moves toward areas where the most liquidity sits, because that is where big institutions can execute their orders without causing slippage. When you see equal highs, equal lows, tight consolidations, obvious support and resistance levels, or clean trend lines, these are not just chart patterns. They are liquidity pockets designed to gather retail traders' stop losses. Banks and smart money don't simply buy because price reaches support or sell because price reaches resistance. They engineer liquidity by tempting traders into positions, forcing them to place predictable stop losses, and then sweeping those stops to capture liquidity before reversing the market. Understanding liquidity means realizing that the market moves to take money, not to respect patterns. And once you learn how to read where liquidity is sitting, you stop trading like a target and start trading like the hunter. Types of liquidity. The first type is equal highs and equal lows, the most common liquidity trap. When a market prints perfectly equal levels, it's not support or resistance. It's a liquidity pool waiting to be taken. Retail traders see these levels as strong zones, but institutions see them as clusters of stop losses just waiting to be swept. Then comes buy-side liquidity, the pool of stop losses sitting above previous highs. When a market pushes up aggressively and takes out these highs, it's not a breakout. It's a liquidity hunt to fuel a bigger move. On the opposite side, sell-side liquidity forms below swing lows. These are the stops, sell orders, and fear-induced exits that institutions target before reversing price back upward. Once these pools are taken, the real move usually begins in the opposite direction. Finally, there is engineered liquidity, one of the smartest traps in a market. This is when price intentionally creates a pattern to attract retail traders, like fake support, fake resistance, micro double tops, trend lines, or tight consolidations, just to build a big cluster of orders. Once enough liquidity is stacked, institutions sweep it violently and drive the market in the direction they originally intended. Understanding these four types of liquidity turns your trading from reacting blindly to anticipating exactly where the market wants to go. Liquidity Entry Model. The Liquidity Entry Model is all about entering after the market has hunted stop losses and collected the liquidity it needs to move in the real direction. Institutions never enter at random. They target obvious liquidity pools like equal highs, equal lows, previous swing points, session highs/lows, and retail stop placements. Once these levels are swept, the market creates a sharp, impulsive move in the opposite direction, giving a clean signal that the liquidity grab is complete. The best entries form when liquidity is taken and the market immediately shows displacement, a strong momentum candle breaking structure. After this displacement, price retraces into an imbalance, a fair value gap, or an origin order block, giving you a discounted for buys or premium for sells entry. Your stop goes below or above the liquidity sweep, and your target becomes the next liquidity pool in the direction of the trend. This model works because you're entering with institutions, not before them, waiting for them to grab liquidity, show direction, and offer a low-risk follow-through entry. So liquidity isn't just a concept. It's the engine behind every major market move. Once you learn to spot where liquidity sits, how institutions hunt it, and how price behaves after a sweep, your entries become cleaner and your confidence skyrockets. Instead of trading blindly, you start trading with intention, waiting for the sweep, the displacement, and the refined entry. Master this, and you won't just avoid becoming liquidity. You'll finally learn how to use liquidity to your advantage.